Well, happy Monday, everyone. Welcome to our Straddles and Strangles webcast. I'm Connie Hill. Glad you joined me here today, and I'm happy to be here. Ted's telling us he's got a snow strangle in place there in the Northeast, and I understand you guys are having some major snowstorms come your way, so I hope you all stay safe and warm and protected from the elements. Let's see here. Some names here are familiar, and I think we've got some new names here as well. So I want to make sure that all of you feel welcome. If you're new, feel free to let us know. Put out a little hello, say, hey, I'm a newbie, and we'll be really nice to you, at least this first time. No, we'll be nice to you every time. Well, we've had some interesting times in the markets the last couple of months or a couple of weeks. We weren't together on Monday because we had President's Day. Hope you enjoyed that. So it's been a couple of weeks since we've been able to follow up on some of our trades. So we're going to spend some time doing that today, as well as looking at some new possibilities. We still have some earnings going on, and so some of the times these are the ones that move really big that we want to use this speculative strategy of straddles and strangles. Well, let's go through our disclosures. I should mention, I think we're going to have Cameron May in the chat here to help answer questions. So as you have them, go ahead, type them in. I'll keep my eye on the chat. Cameron will as well. And try to get your questions answered. So don't be afraid to ask. If you're listening to this on the recording, I know there are lots of you that do. When you have questions, put them in the comment section of YouTube. And I go back and look at those throughout the day. Make sure you get your questions answered as well. Well, let's go through the disclosures and head into our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes only. Don't consider it a recommendation. With long options, you could lose 100% of the funds invested. We're going to be using the Paper Money software application. That's what you download to your computer. It's a little bit different than the web version or the mobile version, although you can see your trades in any of those versions that you're looking at. One thing that's different about Paper Money than your live account is that short options can be assigned at any, well, is that in your live account, short options can be assigned at any time. And Paper Money does not do that, replicate that functionality. So I like to make you aware of that. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right, we've got some newbies there from Hershey, Pennsylvania. Hello, Tim. Happy to have you here with us, as well as so many other friendlies. We're glad that you're here. What we're going to do today, we're going to take a look at some new opportunities and kind of talk through the strategies of straddles, strangles, and something we use a lot called a straddle strangle swap. Now, somebody asked me in the chat, maybe it wasn't in the chat, maybe it was somebody wrote a question to me in the comments in YouTube, and they said, what does the swap refer to when we're talking about a straddle strangle swap? And the swapping refers to the volatility exposure. On a straddle strangle swap, we're selling the straddle in the closest period because there's such implied volatility priced into those options that it's extreme, and we want to kind of take advantage of that. And we're kind of swapping volatility exposure because we buy something a little bit further dated out, where the implied volatility is not as high as it is on that front week or front month, whatever it is that we're happen to be looking at. All right, how many of you have been following along on our trades on Spotify, and Datadog? Hope that you have been. I'd be curious to know how yours ended up. Let's just get on after it here. Let's hop over to our Paper Money platform here. And this is not where I want to start. So I'm going to get rid of that off our screen. Take a quick look where the markets are. Okay, it looks like the SPX is down a little further than it was initially when I was looking at it earlier today. We've got a nice big red candle here. I kind of, maybe go to a 6-month chart. I want you to see the whole Fibonacci here. This Fibonacci move, and if you're not familiar with Fibonacci's, basically it is recognizing patterns that exhibit themselves in our lives. It has to do with our thumbprints and sunflowers, these ratios, and they also apply to stock charts. And so as we look at it, we're measuring a move where we have a definite top and we have a definite bottom when we go in and want to measure that. And it's really interesting. Many times stocks or markets can retrace to about that 50%, which isn't technically a Fibonacci number, but sometimes it uses that a lot. Or it can pull back here to the 61.8% level. That's kind of where it's been hovering around here most recently, is between the 78.6 level and the 61.8 level. So it'll be interesting to see if it really stops here today. Maybe that's the pullback that we receive. We'll kind of see what that ends up doing. So right now we're down about a little bit over 1%. Let's look at the NASDAQ. Many times the S&P and the NASDAQ look very similar to each other. The NASDAQ pulled back further. Okay? It went past its 50%. You can see it's bouncing here, kind of between maybe the 23.6 and the 50% level is where it's been bouncing around. So not nearly as strong as what the SPX is doing. And we could even come in here and draw maybe a diagonal resistance line here, which could be interesting. If you're looking at that type of information, you would notice maybe this horizontal area as a support. You might go, man, that looks like a descending triangle forming there. And it is a descending triangle, which is a bearish continuation pattern. Okay. Is it that extreme on the SPX? We could look, the line would not be quite as long. I mean, yeah, we could definitely connect a line here because the peaks are getting lower, right? The peak here most recently is higher than the previous, or lower than the previous peak. So we could have something like that developing a little bit as well. How about the volatility index? Well, if our NDX is down or SPX is down, we would expect our implied volatility and our VIX measurement to be going up, which it is. So right now it's almost, well, it's at 21.88. So it's above the 20s where things are, you're starting to feel the volatility a little bit more. As I went out and looked at option premiums this morning on some of the stocks we're going to take a look at, the spreads were just really wide. And so some of them are just going to have to deal with a little bit extra wide spreads than maybe what we might find ideal. And then there were some that I just was like, I don't know if we should even go near these because of how wide the spread is. All right. Yeah, Cecil says there's a nice big red candle over there on that SPX and NDX. Somebody is asking a question here, and you guys always have really good questions, which I appreciate and I love. You know, this is more of an advanced class, and so I would expect you to have questions. I would expect you to be stretching a little bit. I know sometimes you feel like you're getting stretched a little too much, but somebody says, isn't buying a calendar better than a straddle strangle swap? You know, it's hard to say what is better, right? There are different ways to attack what we see in the marketplaces, right? You might be good at a particular strategy and you might go, that's a strategy I want to use on it. But it's sometimes really hard to know which one is best. We don't know that in the beginning of the trade. After the fact, it's really easy to pick up on that, right? You're like, oh, well, this would have been the trade that would have been better, but we don't always know that. Okay, so I don't have a really good answer for you there. I don't know if it's better or not. Yeah, Cameron's responding to that as well. Thank you, Cameron. So that's what our VIX is looking like. Let's take a look. We've got some really good stocks that have some good implied volatility priced into their option prices. Now, one thing I want you to make sure you have on your screen is the market maker move, and we're going to talk about that. And I'm going to share this with you, those of you that are here live. I'm going to share this script with you. Remember, anytime we share scripts, they are not guaranteed as to accuracy or timing. Really, you only need the URL on here, and if you only wanted to do part of the URL, it's just the last part that starts with that exclamation point. I'm going to come over here to XYZ for a minute. And I will create a text box here and post that URL, that script, on this chart for those of you that are looking at this on the recording, so that you can kind of have a good look at what that formula is as well. XYZ, it has, of the stocks that I looked at, it had the biggest market maker move priced into it right now. What is the market maker move? Well, the market maker move is essentially what's being priced into the at the money options right now. And whatever is being priced into those options, it's considered the expectation of movement from the market. Now, we don't really know if it's going to go up. We don't know if it's going to go down. Even if something's been downward trending like XYZ, we don't know for sure that it's going to move that amount. Okay. The market maker move, you can see right here on my chart, is saying, okay, it's expected to move about 559 for about 11.16%. And then it'll put these little marks out here. Okay, well, where is that from the current price? Well, it's up here. Looks like 55.69 and down to 44.51 is the expected move. Now, just because it's expected doesn't mean it necessarily is going to go there. We can't count on it doing that, but we're going to trade it with that knowledge. Okay. Let's look at the premiums here on the options. It looks enticing and juicy to us because of a couple of things. One, that implied volatility that's priced into it, and the fact that XYZ has had some big moves. Okay, I'm going to take you back to a one-year chart. And, and there'll be some stocks that maybe don't move a ton and some that do. Okay, so if we come back here, let's maybe zoom in on this part of the chart. We'll look at the last couple, the first two earnings periods in the last year, okay? And what we're looking for big gaps and or big candles, okay? Because that implies big movement, okay? See how huge this gap is from, they announced their earnings at night. So they closed here at, in this case, 58.48. Next morning opened up at 45.33. That is really a big gap. Okay. And so with either of these strategies, straddle, strangles, straddle, strangles, swap, short straddles, long straddles, and so forth, because they're speculative, we really want to see that they typically have made that movement. If it's a stock that really maybe doesn't move that much, then we would not maybe expect that out of it. But if it doesn't really move that much, it probably doesn't have that much of maybe a smaller market maker move. Maybe it's only 4% or 5%. Okay, versus something that's higher. I would say, 8, 9, 10% is fairly high. This one's at 11%. Okay, so we see the big gap there. How about this one? Well, this was not an earnings date, but it did have a nice gap. But look at this. This is where it announced that night. The next morning, what did it do? It gapped clear up here and then slid the rest of the day. So yeah, we're seeing a big long candle. When it just kind of drops and stays there, that's a lot easier to trade, that kind of move, than something like this where it gaps up and then it drops. Okay, because you're like, oh, well, should I trade it bullish up here because it had that big move? It kind of keeps you guessing, and sometimes we don't guess the right way because we don't know that it's going to stay there. So we kind of have to watch it for a little bit just to make sure. You can see with, say, the date the announcement comes out or the reaction to it, how that implied volatility just crushes out, is what we call it, a volatility crush, that drops. And so what does that do to option prices? Well, it collapses them, right? They were like a balloon with this, this air in it. And then once the news comes out, a lot of that air comes out of the balloon, okay? That's the impact that we're seeing here. On this particular one, we could see a decent drop here, right through this day. Sometimes they're bigger drops than others. Okay, let's fast forward to the last couple here. Nope, I skipped by one. Nope, we didn't skip it. Here it is. All right, so this one. The day they announced earnings, and again, these guys do it after the close. And so it went dropping going into the earnings, had a huge drop clear down here. I mean, that is a pretty big drop. And in this case, then it climbed up. So, you know, we might have been saying, all right, we're going to play the bullish or we're going to play the bearish side of this because we got the big drop. But then it kind of started moving against us. So ideal time to take profits on this one, say on the bearish side, probably would have been right at the beginning of the day, but you don't really know that, right? We don't really know what happens at the rest of the day. And it's kind of like on this candle here. It gapped clear up. The ideal timing to have taken profits on the bullish side would have been up here first thing in the morning. But again, we don't know if it's going to keep going that direction or not. Okay. But interesting enough, we can use that to our advantage by saying it seems like it switches a little bit after it makes the initial move, at least on, let's see, those two moves. And on this one, it didn't reverse at all. Okay, it just dropped, went there. And like I said, that makes it a little bit easier to trade. Let me see what kind of questions you've got going on here. Ted wants to know what's the percentage probability or number of standard deviations expected in a market maker move. There really is not a measurement against the standard deviation. Okay, it really is what is the price of the at the money straddle, and let's just graph what that is because that's the expected move. Okay, so in some it could be within the first standard deviation, and others maybe it's a little bit further out. When we put a trade on, we'll go to the risk profile tab and take a look at the trade that we're looking at, see if it's appropriate. Gina says, you know, do you use the market maker move primarily near earnings? Not all stocks actually have this market maker move showing for them. Okay, they don't go out and calculate that. If I come over here to the trade tab, right here is that market maker move. So a lot of stocks you'll see it at earnings, but not all stocks. Or if it's, you know, they're not going to announce for like a couple weeks, then usually you're not going to see that market maker move up quite yet. When it gets within a few days of being ready of a big announcement, that's when we typically see it come on. But it could be for an FDA ruling on a pharmaceutical company's drug, like, right, the FDA will say, hey, we're going to tell you what we think of it on X date. Sometimes we'll have a market maker move or something like that. Or if a lawsuit is being, we're going to know the outcome of some big lawsuit on some particular day, many times they'll do a market maker move for that event. Okay, so it doesn't have to be near earnings, but in our class, because earnings come on for like 6-7 weeks out of our time, then we use it a lot because of earnings. So great question there. Now there is a survey out in the chat. You guys know, well, if you're new, you might not know, but from time to time we'll put a survey out in the chat to kind of get your feedback as far as how this particular session is going. And it's really easy. 2 questions. You just pop into the radio button on a scale of 1 to 10. Pop, pop. You can be done there. There's a couple places you can answer some questions, and you can use that space to communicate information to me as well. If you want to know, or you're struggling with a concept or something like that, and you want me to bring it up in one of our next sessions, tell me, because I like to incorporate those things into our classes. All right. Cameron probably has that posted at the top there as well. So you can just click on the link and let it sit in the background. And then when it's time for you to leave or we wrap up the class, then go ahead and fill it out. All right. Oh, Cameron's got a little article there for us about the market maker move. I'm gonna have to check out what that article is. Thanks for posting that in there, Cameron. Appreciate it. All right. Now we've looked at the chart on XYZ. I'm hoping that the spreads aren't as bad as they were before. Okay. Let's look at what we have here. For the week where these are going to expire, the implied volatility is 139% priced into that. And then the next week out, look how much lower that is, 94%. So it has over 130, or it has over 40% additional implied volatility priced into that. That is big. Okay. When I say big, I would say anything above, like say 10% and above is big, but this is up there at 40%. So that's why it's really big. So we see that it has the moves. We see we've got implied volatility price there, and that might guide us as far as, well, which strategy do we think we want to do? Do we want to sell these option premiums and take advantage of that? Or maybe we don't. We don't have to. We could come out here and do a vanilla straddle if we wanted, or strangle. Let's just take a look at this, and we probably do not need 50 strike prices. Maybe let's just go with 30 here. There we go. All right. So our at the money right now is going to be the $50 strike price. And so if we wanted to sell premium and take advantage of that, we would sell the at the money straddle. So the 50 call and the 50 put is what we would sell. And the spread right now is not looking too bad. Okay. It was a little bit wider before, but we're just looking at what, 12 cents here. This one a little bit less than 30 cents, which is getting to the high side, but not too bad. But there are some strikes that are really bad that you might notice along here somewhere. Sometimes it happens when there's not as much open interest contracts, or if it's a new contract, sometimes the spread will be larger on that one just because we don't have the open interest there to support it yet. Okay. All right. So the market maker move shows something different than the implied volatility. It actually, it's not showing us the implied volatility amount for, say, a given strike price, but it is saying this is the expected move for our at the money straddle. We're going to expect it to move $5.58, and on a $50 stock, that's over 10%, right? It's at 11% we saw. So this specifically is related to implied volatility because it's the implied volatility that's higher, that like what we can see here, 139%, that is inflating those numbers, that is making it so big. So they're very much related, but this is more specifically what's the expected move, and it encompasses implied volatility as part of it. So I hope that makes sense. Yeah, Cameron's saying there are different gauges for measurement of that implied volatility. Okay, let's look at here, see if this looks a little bit better than it did earlier. Okay, if we were to sell the straddle here, we're going to sell the call and we're going to sell the put. I clicked on the put first. I'm going to select on the call, and I held down my control key on my keyboard. That's how we can put in, click here and click there, and allow the trade to build up down here. If you don't have held down the control key, it's going to replace it. Okay, but you can see right now, oh, figured out that's a straddle. What's the credit we're looking at there? About $5.71. Usually it is pretty close to whatever this market maker move is. Might be off a few pennies because of the spreads that we have in there, but usually it's pretty close to that. So you're looking at that going, yeah, 571, 555, yeah, it's pretty close. All right. Now, if we wanted, we could just sell that straddle the way it is. However, that gives us a lot of exposure that we really probably don't want, right? It could give us exposure of a naked call, which has theoretically unlimited risk potential. A naked put, which a naked put, some might say maybe it's not quite as dangerous because but the stock still could drop to zero, and maybe you're put the stock, and yeah, theoretically it could drop to zero. But when we're looking at things that are trending in the market or above, say, that $10 price tag, we can kind of use that a little bit of a filter. That the stock is not as likely to go to zero if it's a higher price, right? If it's a $400 stock, not as likely to go to zero, but theoretically the risk is still there, okay? So what we might want to do here is a straddle strangle swap where we try to capture as much of this implied volatility as we can. But to do that, we probably want to have our safeguards out. So we're going to go buy an out of the money put and an out of the money call. And we're going to use a different time period. We could either use the March 6 options or the March 13 options. You can see both of them are considerably lower. On this one, let's see here. I was looking at doing the March 13. I think this one had a little bit more liquidity in the options, but we'll take a look here. And this was where I was a little bit concerned. I was like, they're kind of wide. Some of them are, not all of them, but some of them are a little bit wide. So we're going to come out, we're going to look for, and this doesn't have to be the magic number all the time, but we're going to look for a 30-something delta, okay? It's going to be out of the money a little bit. It's going to give us a little bit of protection, but we maybe don't want it to go too far out of the money in case we need to use that protection, okay? You know, if we came out here and went, oh, let's do the 25 strike price, I mean, that is way out there. So we're going to kind of shoot for a 30-something or high 20-something delta. So in this case, I wasn't liking the open interest on this one, 5 contracts, 15 contracts. Now, a little bit further out of the money is 28 delta. It gives us 61 and then 78 contracts. So it's a little bit more comfortable there. So we're going to go a little bit past, say, a 30 delta. We're going to go out to that 28 delta. And we are going to buy at 183 on that premium. So I'll hold down my control key, click on that ask price. Then we're going to do the same thing on the call side of things. Well, where's the 30-something delta? We've got a 31, a 34, down to a 26. This 31 has a lot of open interest here, not too bad. Now, right now, the spread is looking really artificially wide. Man, that is so wide that does kind of scare me. I was hoping that we would see it be shrinking back up here now that the market got engaged. But we do need protection. We absolutely need some protection. So maybe what we'll do is maybe we'll go a little further out of the money here. Still not liking this spread, but know that if we want to sell that premium, we need the protection. So let's go ahead and let's try to get this at a midpoint price. So let's go at the 28 delta here, the 58 strike. Unless one of these others looked like it had a closer tight spread, but it looks like they're all spread out rudely. They're very rude right now, spreading out so wide. Yeah, March 13th is a Friday the 13th, warns us. Dragon Rider warns us that's true. Bitcoin Man says, what is this, a strangle? So when we go out of the money, it's called a strangle. At the money, straddle. Out of the money, on the call side and put side, yeah, then that's going to be in this case, a strangle. Okay, so we're going to buy that hedge. Again, we're going to do it, but I do not like this spread here. Let's go with the 59 on this one. Oh, did I already click it in there? Maybe I did already click it in there. Okay, I already clicked it in there. I went with the 58. Okay, we went with the 58. Okay, so our credit that we have remaining is about $3. That's what we're trying to capture. And then if it moves really big one way or the other, maybe we might end up using our long put or long call if there's an obvious move and that stock makes a big move so that it's worth capturing. Okay, that's what we're looking at here. We're going to go ahead and do it. I'm going to put a note on here that this is not my favorite. I'm going to say wide spreads, and we're hoping that they kind of I'm going to say wider spreads. That's going to be our concern on this trade. Okay. But that implied volatility is so juicy, it's kind of like, oh, let's try it anyway. All right. Let's go ahead. We're going to put this into our straddles and strangles bucket. So how do we manage this trade? Their earnings are on the Thursday. They're going to be on the 26th after the market hours, so when the market's closed. So how somebody might monitor this is going to be late Thursday night, early Friday morning. You're going to see what is the market's reaction to it initially. And if you can see it that night, it kind of gives you an idea. But it's not guaranteed to be there in the morning. Okay, it just isn't. And so Friday morning, we're going to watch it. And we're going to see initially what direction does it go? Does it go up? Does it gap down? And then maybe watch it, this after the market's open again. Does it hang on to that move? Or does it look like it's quickly reversing like we saw in those candlesticks from the last two earnings? It moved down and then rallied back up. And the other one popped up and then dropped pretty quickly. So the monitoring piece, a lot of it's, and possibly the whole trade, could be getting out that very next morning when we really see what direction it's moving. Some people might put in profit targets. I think that's a little bit hard to do in the sense that we just don't know how big of a move it's going to take out of it, right? So some people might end up closing out if they look at their spread the next day and they see that it's a positive value that they're like, that's worth just capturing. They might go ahead and close down the whole trade right then and there. Sometimes it takes a while to see which way it's really going to go so that you can manage it. Now, I do want to reiterate here, these strategies are speculative, okay? That means they probably are not going to be for everybody. It means they're probably not going to be for somebody that's newer in the market to cut your teeth on. I'd say, go to a safer strategy or something that is not so speculative, maybe a higher probability strategy. Whereas these ones, you could strike it big and you might not. We just don't know how it's going to work out for us. Okay, so we're going to be monitoring it. One thing we could do if we wanted to is we could put a profit target out there and say, well, what was our ending credit? What did we get filled here on? We got filled at 288. What if we had 150 in profit the next morning? Would it be worth it to take it? That's about a little bit more than 50% of what our initial credit was. Yeah, so you might go, that might be worthwhile for us to do. Okay. Do a ton of them in paper money. Can I repeat the significance of the Greeks using this strategy? Quite honestly, the Greeks, probably the biggest one impacted is going to be the Vega, that volatility, that looking for that crush of implied volatility. That's probably going to be one of the bigger factors on this one. And then the second one's going to be the delta. How big does it actually move once the news is out? Say it doesn't move a whole lot, but the implied volatility comes crushing out of it. That presents an interesting situation where maybe we see ourselves in a situation that is decently profitable. And we're like, okay, let's go ahead and take those profits. Could also mean that you look and you go, I think we're going to go bullish on this. So maybe you decide I'm going to sell the call, salvage what I can out of that long call. Well, I should say, I didn't say what direction it moves. Suppose it pops up, so you think it's bullish, then it's going to be on that long put. You'll go, okay, let's maybe salvage what we can out of the long put. Sometimes you can salvage a lot, sometimes you can't. Sometimes you may exit this trade one leg at a time. You might exit all four at the same time. Okay, so it's one of those that you're monitoring and making a decision on. You don't always know if that's the best decision. Okay, so there's one other one I want to put on here real quick, and then I want to talk about our Spotify trade. Okay, so the other one there's a couple that look really juicy here. Let's look at SNOW, SNOW. It is another big mover here, 12.54%. That's the expected market maker move. You can go back and you can see, oh yeah, gap, big, maybe not as big of a gap, but yeah, that's a decent sized gap up to here and continue to run. So it is a big mover. If we wanted, we could say, well, let's just try to play the big move. Okay, if we wanted to just play the big move and not try to capture the implied volatility, what we might decide to do is go a little further out. Maybe we don't want to buy these ones, right? That have all that implied volatility priced in them. Maybe we want to go out a little bit and play that move. So we might come out here and say we might just go to March. We might buy a strangle or a straddle. We could decide which way we wanted to go on it. Okay. This one, some of the spreads are a little bit wide, but again, we're seeing high VIX. When we're seeing higher implied volatility, those spreads do get a little wider. Okay, we're going to throw this one together pretty quick here. We're going to do a straddle, selling the at the money straddle, and then we're going to do buy an out of the money strangle a little bit further out, where implied volatility isn't quite so expensive. Okay, so on this one, let's go 162.50. Is that still about the right price? It's not. We're going to have to swap that out here. 157.50 is probably our at the money strike here. So again, I'm going to hold down my control key, click on the bid price on both the call side and the put side. That's a pretty decent premium. And then we're going to go out to the 13th of March, a little bit further. It was interesting, the prices weren't that different. However, the open interest I was looking at here, our strike prices changed, and I had kind of picked them based on what was in the ballpark of that delta, but also having some better open interest. So, and a little bit tighter spread. Let's just look real quick at the sixes. See if there's a little bit more open interest out here. So we got 162. Oh, and then we have 72. Let's do this. Let's buy the 145 put. Click on that ask price, and then on the call, we'll come down here. There's a 39 delta with 215, a 33, a 28. Let's go with this 28, and we'll go ahead and buy this call. That's still going to give us a credit of about 10 bucks. So if we, the next morning, we see that we've got 5 of that remaining, we might just go click and get out of it. If we had maybe 200, you know, that we would close it out with about $200 of credit, we might hit click, get out of the whole thing, rather than trying to leg out of it. Okay. And that's why it's really important to do a lot of these in your paper account, just so you get kind of comfortable with how does this managing of it work? How do we do this? Okay, let's go ahead. Let's put this in and let's save some time to talk about Spotify here. So we're going to put this in our straddles and strangles bucket. All right, let's go to Spotify. This was a trade we did 2 weeks ago in our class. They had earnings coming up, and they are a big moving stock, and they had a lot of implied volatility priced in there. At that time, let me see if I wrote it down in my notes, how big it was. It was 9.95, so it was almost 10% priced into those options. All right, come over here with me. This is when we entered the trade. That was at our class on the 9th. And then they announced the next morning? Yep, the next morning they announced. So it closed here, gapped clear up to here, and then started running, and it got a little bit high here. Now, I'm going to tell you, as I was monitoring this, I was like, oh, that's a pretty good size move. And I put this number here, this 468.82 number. That is where it looked like it was going to open. And so I just wanted to keep track. Well, where is it from the in the early morning before the market actually opened. Where did it look like it was going to start? And it did start pretty close to that. And again, ran up. At this point here and at this point here, the next day, these would have been profitable points to close out the entire trade. Okay, just from what I was seeing, but we quickly started to see the profit just kind of melt away as that little price, when that shadow was developed there, as the price was fading. Okay, what do we end up doing here? We ended up doing, let's go to account statements, Spotify. Here's our credit we brought in, 1915 credit. And the next day, first thing in the morning, we said, let's go buy back the short call. It's our short call that doesn't make sense, right? It's our short put that we wanted to hold on to because the stock gapped up. So that was the profitable leg. So we came in here, we bought it back for a chunk of change, 64.45. And so I went through and I did the math and I said, okay, we need now for that profit to get us up in the neighborhood of about $45. And so it was there for a little bit, but it was a strong move. So we thought, well, we'll just kind of watch it, see what it does. Turns out, like I said, the price didn't really go back to these areas until last Thursday and Friday. We held on to this thing till Friday. Okay, the rest of it, most of the rest of it, I should say. We held on to it. We got out at about, let's see what time of day we finally got out. We got out at 7:52. So the market had been open at my time at 7:30. So it'd been open for about 22 hours and it looked like it was just hanging and not going to move much. How do you gauge that? You come out here to a 1 day, 1 minute chart. So this was last Friday here. You could see it kind of ran up a little bit, pulled back, and it was like, oh man, it might not run up very high. So we got out, what was that, 7:52? Oh, I'm trying to get my mouse right there. It was just kind of hanging in that area. It didn't look like it was going to run much. So I said, let's just salvage what we can out of it. Let's go ahead and sell it. Okay, so we did. Ended up selling it. Then later in the day, it ran higher. Now, it's nice that it ran higher. We didn't know that it was going to run higher, but if somebody were maybe a little bit more patient, wanted to hang on to it longer, they maybe could have found a little bit better exit point on it. Okay, but by the end of the day, it faded. Okay, it just began to fade the rest of the day and kind of closed near the area where we got out. Maybe a little teeny bit higher is all. Okay, so we just never know how they're going to go. That's how this one was. We ended up taking a loss on that one. It was an ugly loss. The value I wrote down here was, we ended up losing $1,669. So almost $1,700 on that one, which you're like, oh, that's painful. And with a strategy that's speculative, yeah, it might not be comfortable. That's why I say these types of strategies are not for everybody. They're very speculative. And some people, they're not going to be in their bread and butter strategies. Okay, maybe other trades that aren't based on speculation, aren't based on trying to capture that implied volatility and a big move, might be something in somebody's comfort zone a little bit better. I don't have a problem with that whatsoever. Okay, now we're almost out of our time here. We're going to watch these couple of trades. Somebody will be watching them towards the end of the week when they announce their earnings. See what happens to them. I hope that you are a subscriber to our Trader Talks channel. Just makes it so much easier for you to find our content. There's a little blue button in the bottom right-hand corner that says subscribe, and it looks like a YouTube button or YouTube logo. You click on that and that'll subscribe you to the channel. Then you're going to see, oh, we've got playlists. You can see what's coming up next and so forth. So I ask you to be a subscriber. If you'll fill that survey out for me, we always appreciate it when you take the time to fill those out for us. Okay, so there's the survey. Cameron's reposted it there in the chat. And Cameron and I would love you to follow us. Extend an invitation to you to follow Cameron May CS Connie Hill CS. We'll post educational content out in our X account that we find interesting and we think you might be interested in. All right. That is our class for today. Now we're going to take a little break in our programming. Up at the top of the hour, it's going to be Barb Armstrong with Trading a Smaller Account. I know lots of you love that class, so we'll be seeing you there in just a few minutes. So if you want to follow along, put this in your paper money account, right? It's always going to be in your paper so you can practice, you can see, then we can compare notes. How did you manage it? How did we manage our class trade? All right, you guys, I'll see you next week in this class, but we'll be back in 15 minutes.